I'm back with Steve Hanke, professor of applied economics at Johns Hopkins University. On the agenda today, the historic U.S. intervention in the Japanese yen market. This is the first time that the U.S. has bought yen at this kind of scale since the 1998 Asian financial crisis. Why did they intervene to prop up the yen? What would have happened to U.S. markets if they didn't? Secondly, we'll be examining the future of bond yields and the bond market in the U.S. Why did bond yields spike dramatically last week after the FOMC meeting? What can we expect to happen to economic growth and inflation from current monetary policies? Welcome back to the show, Professor Hanke. We've got a very exciting show today. Thanks for being back.
Well, David, great to be with you as usual.
Let's start with the top news of the week for currency markets. The yen has been falling for many years now, quite a few years. It's been trailing lower and lower. Just last week, it made a historic 40-year low against the U.S. dollar. Then all of a sudden, it spiked dramatically from 164 all the way back to 157 to the U.S. dollar. And that's because the U.S. government, under the supervision of Secretary of Treasury Scott Bessent, authorized the purchase of, nobody knows for sure, but it's speculated around $5 to $10 billion because that was the amount on a note that Bessent left on his desk at a Camp David meeting the week prior. But anyway, the U.S. intervened in the Japanese yen market to prop up the yen. I'll show you what Bessent and Trump had to say about this and why they did this, but your speculation as to why they made this historic move. And like I said in the beginning, they haven't done this since '98.
Well, let's see what Trump and are you going to run something on what Bessent and Trump actually
said?
Sure.
You know what? Let me play Trump's clip first.
We have a good relationship with Japan. We're very strong, very, very strong financially. They are, they have a weakening yen, and they wanted a little bit of help, and we're always there for Japan. Japan's been very good to us, with the exception, of course, of Pearl Harbor.
Mr. President,
they were not good.
I don't know why he said that. Anyway, that's what Trump said.
Okay.
Let me show you. Would you like to see Bessent on CNBC first?
Yeah, I would like to see Bessent.
Okay, let me just pull that up real quickly here.
The U.S. and Japan confirmed a coordinated yen buying intervention. Join us now with the details of how it came together. Treasury Secretary Scott Bessent. Mr. Secretary, it's good to see you this morning.
Joe, always good to be with you.
You know about the yen. I guess you had some experience in the private sector, maybe from the other side of the trade at one point. Is there anyone who is as adept at working with yen? I don't know. Is it manipulation? What is it? Support? Or in the last case, it wasn't support. It was actually shorting it, I think.
Well, Joe, I think it's important to have a framework here, and just to level set here, the framework begins with the strong relationship between President Trump and the Prime Minister, and I have an extremely good working relationship with my counterpart, the Finance Minister Katayama, and I've been going to Japan since I think 1989. And have more than 50 or 60 visits here, so I'm well versed. But what's important here is we've been in close contact with our Japanese allies, and they are great allies in the region, both militarily and economically. And we understand that they are making serious efforts to stem the substantial undervaluation in their currency. And Joe, this is more than just a market intervention. That through our conversations with them, we believe that they are going to continue to put the right policies in place that will lead the yen to get back to more of a normal equilibrium price.
Yeah, I was wondering whether you've got some ideas about how Japan needs to do that, because there obviously are still some problems. Rates are probably negative there with the short-term rate at 1%, and we think we've got it tough here in terms of debt as a percentage. I think they're at 230% right now. That's almost hard to believe. Mr. Secretary?
Well, there are a lot of ways of counting it because most excuse me, much of it is held by Japanese citizens and by their pension system. So, I think if you net it down, it doesn't look like that. And the other thing, too, is, look, they're moving toward budget discipline. They're going to have a primary surplus for the first time. And, Joe, if I put on my economic historian hat and look back, that, I in the late 90s, 97, 98, the Asian financial crisis, in my opinion, part of it was triggered by an overly weak yen. So I think a stable yen is not only important for the U.S., but it's very important for the entire region, because if the yen were to weaken substantially, then the other currencies would follow it. We'd seen excess volatility in the Korean won. Many people believe that the Chinese RMB is undervalued. So, given the trade flows, given the size of the economy, given their contribution to the global savings market, very important to have a stable yen. The Japanese government understands that, and we are proud to stand with them in implementing their policies and help them stabilize the region.
Before we continue with the video, let's talk about your most important asset, your personal privacy. Now, you've probably never voluntarily handed your personal information to a data broker, but they have it anyway. Your name, home address, phone number, even details about your family are collected and sold to whoever is willing to pay for it. That's why today's sponsor, Delete Me, is a service I use to cut that down. Setup takes a few minutes, and after that, their team does all the work. They find where your information is listed, verify it, and submit removal requests to hundreds of data broker websites around the internet. Then they keep checking because these listings tend to come back. Since June 2024, they've been reviewing my listings, and my most recent report showed 335 listings reviewed last month alone. Scan the QR code here on the screen or go to joindeleteme.com/David Lin, link down below, and use the code DavidLin for 20% off. Take back control of your privacy today. Now back to the video. I'll stop right there. Stabilizing the yen is important for not just Japan, but stabilizing the entire region and also the U.S. economy. What does he mean by that? Ultimately, if a taxpayer of the U.S. government, if an American taxpayer were to ask you, Mr. Hanke, why did my taxpayer dollars just go to bail out Japan when we have problems of our own? Is ultimately my question. How would you answer
that? Let's set the whole table on this thing, because
yes.
I think what the secretary was saying didn't really make much sense. By the way, the yen had closed at its weakest level. It was about 164.
Yes.
To the dollar, its weakest level since 1986. And the intervention that occurred, as you indicated before, you said, well, it spiked up to it's now about 157.5, but that's only about a 4% appreciation. That doesn't amount to very much, really. Now, so whether this ends up being a dead cat bounce or not, I don't know. It probably will be a dead cat bounce, because before the joint intervention occurred on Monday, the short positions against the yen, in other words, those who were betting that the yen would go down even further than the 164, maybe 170 or something like that, they had huge short positions on. So that kind of is the background. Now, let's talk about the key thing that was said. Trump said his good relationship with the prime minister and Bessent. The first thing Bessent said was Trump's relationship with the prime minister. So obviously the Japanese wanted the intervention to stop the rout against the yen, and the reason they did that is that if they intervened alone with the Bank of Japan and the Ministry of Finance in Japan, they couldn't cut it. They just don't have the firepower, and they're not credible. They've been intervening, by the way, all the way down. As the yen has weakened, Japan has been intervening. So they needed the United States to come in and say they were going to backstop the thing in some way. So that's a little introductory remark. I am one that is always skeptical of these interventions. And what you have usually with the interventions, they end up creating more volatility than anything else. Yesterday, I wrote an article, my column in Fortune magazine. I laid this out, and meddling by big players, because Besant is a big player, and what you have now, we've never had a Secretary of Treasury in the last 30 years that's intervened in the currency market to support the yen one way or another. Now we do. So it makes people move away from market fundamentals and what's behind this yen going down. And they're looking at the big player, who's Besant and Trump. Well, what are they thinking? What's going on? So that is market manipulation. The big player comes into the picture, and all of a sudden, the analysts and the traders start looking over their shoulder and wanting to know, well, how's the big player going to manipulate the market tomorrow, or is he? What's going to happen? And they stop looking at fundamentals. Let's look at the fundamentals. Let's get into the fundamentals. The fundamentals are the following. Everyone says that the monetary policy in Japan is very easy, and it's very easy because the interest rates are low in Japan. Now, monetary policy is not about interest rates, David. It's about changes in the money supply. and the money supply is growing now at a very anemic rate, and has been growing at a very anemic rate in Japan for a long time. It's currently growing at 2.2% year over year. To be consistent with hitting its inflation target at 2%, it should be growing at around 6%. Hanke's golden growth rate, 6%, a rate consistent with hitting a 2% inflation target. Well, what is the inflation in Japan? It's 1.6%. It's below the inflation target. Why is it below the inflation target? Because the money supply is only growing at 2.2%. Now, that comes into the yen, because the growth rate in the money supply will put a ceiling on nominal GDP growth. That is, real growth rate plus inflation rate equals nominal GDP growth. And the ceiling will be put on it by this 2.2% growth rate. The overall growth isn't going to be much different than the 2.2% rate of growth in M2 measure of the money supply in Japan. Now, if you have very low inflation, you'll get low interest rates and you'll get low economic growth. And when that happens, the currency gets weak. Low interest rates, low economic growth, weak currency. Now, on top of that, this prime minister that Trump is in love with is a new prime minister, and she has indicated that she wants to increase military spending and almost go to war with China, by the way. So that throws a lot of risk into the picture, and that makes the currency weak. They already have this huge debt to GDP ratio, and she wants to increase government spending, and by the way, and cut a few taxes. So in fact, the deficit will get bigger, not smaller, and the debt to GDP ratio will get bigger, not smaller. All of those things are behind this weakening yen and the rout of the yen. And that's why all the hedge funds were tremendously short the yen and driving it down. Now with this intervention, there's been a little pause. but we'll have to wait and see. I think the fundamentals point to more yen weakness. That's where the fundamentals come into the thing. Besant is a big player, and we'll see what Besant does going forward, but we don't know. With a big player, you don't know what's in his mind. You don't know what he's going to do next Friday. Last Friday, he slipped that note out saying that they were going to buy 5 to 10 billion. They were going to spend 5 to 10 billion of U.S. taxpayer money to support the yen. You see. Anyway, that's the nub of what's going on. It is unusual, and it suggests that we will have more volatility in the market, and it's also consistent with the Trump administration's interventionist policies. These are interventionist policies. We've politicized the market with a big player. We politicized it.
Professor, let me show you a few charts. I will talk about the yen carry trade and why that's important for the U.S. markets. Ultimately, going back to why they did this. But going back to what you said about why the yen has been depreciating, this is something that's intrigued me when I did some research. So here in front of me, I have a picture of the USD yen cross. So we have, as you can see, a depreciating yen ever since 2021 by quite a lot.
Make it clear that people understand this. As that line goes up, that means the yen's getting weaker and the dollar's getting stronger.
Correct. This is USD yen. So dollar strengthening versus yen means yen's been getting weaker. Now, I want to show you something else because typically currencies track interest rate differentials. In the same period, this is a chart showing the U.S. 10-year yield, the U.S. 30-year yield in the bar chart and the Japanese 30-year yield in the blue chart. Like you said, the Japanese 30-year interest rates have been low historically compared to the U.S. That's been true between 2020 to 2023, which may explain why the yen depreciated between 2020 and 2023 when U.S. interest rates went up and the Japanese interest rates stayed the same. However, I don't see how that explains why the yen continued to depreciate against the U.S. dollar when the Japanese interest rate here in the blue line, once again, dramatically started shooting up in 2024 and now surpasses the U.S. 30-year yield. That doesn't, when that interest rate moves up even faster when the Japanese interest rate moves up even faster than the American interest rate, shouldn't economic theory tell us the yen would stop depreciating and go up?
Well, you get it. You've got a 30-year. You think the hedge funds are borrowing money at 30 with a 30-year duration? I mean, you must be kidding. You got to get something a lot shorter than that. You know?
Okay. All right. So
that's one thing. Now, by the way, let's leave this on for just a second because everybody keeps looking at this thing and they don't realize that the sequence is this: money supply growth with a lag will affect inflation, and we know. I said the inflation rate's 1.6%. The year-over-year inflation rate in Japan. So that suggests yields follow the inflation rate, and that suggests that that the yields are going to come down, not keep going up.
Yeah. Okay. That is a good explanation. Professor Hanke, ultimately, okay, by the way, I want to point something out to you. The U.S. apparently didn't just sell dollars to buy yen. They actually sold euros. So let me just read you this Fortune article here. U.S. is using euros, not dollars, to prop up the yen. It may backfire. So the first paragraph here, the U.S. is stepping in to help boost Japan's yen for the first time in nearly 3 decades. The intervention has an unusual feature. Instead of selling dollars to buy the yen, the New York Fed reportedly sold euros to fund the purchase. The coordination move on Friday lifted the yen to 157, which we talked about. Japan is estimated to have spent $52 billion. The exact amount from U.S. is unknown, although, like I said earlier, a photo of Besant's notepad suggests a range between $5 to $10 billion Mark Sobel, who served in the Treasury for 4 decades, had something to say about this. The U.S. is unwise to enter the market in support of the yen, even if it makes a small profit in doing so, unless it is part of a Japanese plan to tackle the fundamental issues driving yen weakness. Okay.
Well, I agree with Mark Sobel. Point number one, I agree with Mark Sobel's statement. I think it was unwise. But going back to the euro thing, it's obvious that they didn't want to be selling dollars because of why they don't want a dollar weakness to show up in the picture, because that would be a negative for Trump. Remember when Trump got on the plane, he's always talking about strength, strength, strength. Well, you don't want to be selling something and making the price go down if you want to look like you're strong. So they did it indirectly. That's what's going on there.
Do you think that if the U.S. didn't intervene, then the yen would destabilize further and cause perhaps another Asian financial crisis, which is what Besant alluded to?
Well, no, I don't. I think the short positions were huge, and the yen would continue going down because the fundamentals point to going down. Besant is basically saying, I don't agree with the fundamentals. I don't agree with Mr. Market. I have an idea that's different than the market. The market has an idea. The yen's very weak, and everybody thought it should be even weaker. Okay, that was the market, and Besant says no. I don't like that, and so I'm a big player now, and the big players, by the way, aren't confined and constrained by profit and loss considerations. That's part of the definition of a big player. I mean, there can be big players, lots of private hedge funds and so forth, but a big player by our definition, or my definition, is one that uses discretion, and that discretion is not constrained by any rules or guidelines like profit and loss. Or any rules like the gold standard, or that would be a rule. So that there are no fundamentals that surround a big player. A big player operates with discretion and is big. They can move the market. It's not you and me talking, David. It's some guy who's got lots of ammunition, and in that case, what happens is that the fundamentals in the market become less important, and the big player, the politicized individual, becomes a bigger factor. So it creates a lot of noise in the market and a lot of volatility.
Right. Do you think Scott Bessent and Trump were trying to prevent a U.S. market sell-off ahead of the U.S. midterm elections? The theory here is that if they didn't intervene in the yen market, potentially the Bank of Japan would intervene and raise interest rates further to stop the yen from depreciating. If that happens, the yen carry trade unwinds. The low interest rate that you mentioned earlier for Japan would go up. People would have to sell U.S. assets. If they borrowed in Japanese yen at low interest rates, now all of a sudden it goes up. They'd have to sell U.S. assets and sell and buy back their Japanese bonds. Is that what's going on here? Do you think?
I think that is. I think the carry trade that you just described, borrowing at low interest rates in Japan and placing the funds that you borrowed in higher yielding assets denominated in other currencies, it is a factor. The carry trade's a big factor, and the carry trade is big in Japan. It always has been. Japan exports a lot of capital, and they export a lot of capital because even though there's a deficit and deficiency with public savings being a lot less than investment, the private savings are huge in Japan, and they swamp the public sector deficiency in savings, so that in aggregate, if you add the public sector and private sector together, there's a huge surplus of savings being much greater than investment in Japan. And what happens? They export the capital, and it's through the carry trades. And the carry trade, the vehicles are the hedge funds. That's how the capital flows out of the excess savings, shall we say, flows out of Japan. So that is a factor. Another factor is that what if the Japanese would intervene by selling the U.S. bonds that they hold? They hold a tremendous. They're the biggest holder of U.S. bonds, government holdings. I might not be speaking correctly here. China could actually be greater, but let us say they hold a lot of U.S. government denominated U.S. government bonds, dollar denominated bonds. Now, what if they started selling those bonds, those dollars, and buying yen? So that's another factor. So the carry trade's a factor because that flow of capital out of Japan, some of that comes into the U.S. bond market, and some of it comes into the U.S. stock market. So that's a positive flow of capital into the U.S. markets, and if it's cut off, that's support that's not there. The other factor is more direct, and that is, well, what if the Japanese actually started selling some of their holdings of U.S. dollar denominated government bonds and use those funds to buy yen? So that's another thing, because that if that happened, it could start somewhat of a bandwagon effect. That maybe then the Chinese would say, "Oh, we're going to do that," and if they did that, by the way, the price of the U.S. bonds goes down, but the yield on U.S. bonds goes up. That's just what they don't want.
Yeah.
And right now, by the way, Besant's big thing is he doesn't want the 10-year yield on U.S. government bonds going above 4.5%. But the fact of the matter is, today, as we speak, David, the 10-year is at 4.637. It's already over his red line. So he certainly doesn't want any foreign government selling U.S. bonds, because if they do, the price of the bonds goes down, and that interest rate, that yield goes up, which he doesn't want. And the reason they don't want that is because they have to roll over the huge amount of debt that the U.S. has. Remember, the U.S., the debt is over 100% of GDP. The debt held by the public is over 100% of GDP. A lot of that is in short-term treasury bills, less than 2 years in duration, and they have to roll those over all the time. And if the interest rate goes up, the cost of rolling over goes up, and that's a big problem, because now interest servicing costs amount to 35% of personal income taxes. So of every dollar that comes in personal income taxes, 35% is siphoned off, just 35 cents. 35 cents is siphoned off just to service the debt.
Either way, this is giving off vibes of a repeat of the Asian financial crisis. I'm not saying there is one right now, but the last time that the New York Fed organized a private sector bailout was in 1998. And the fact that they're doing that now probably signals to at least some investors that there's really trouble brewing in Asia right now. Would that be a fair assessment?
Yeah, I think that's something that's something that's on the radar screen, something I know about, because in 1998, in the Asian financial crisis, I was right in the middle of it, because I was President Suharto's chief economic advisor in Indonesia. So, and the epicenter, this thing started in Thailand. The Thai baht blew out in July of 1997, and then the next big one, the Indonesian rupiah, collapsed. And who was brought in to save the rupiah? The money doctor, yours truly.
Oh, what did yours truly do?
Well,
or suggest?
I advised Suharto at the time to introduce a currency board, and a currency board would have done what? It would issue the rupiah. The rupiah would have traded at a fixed exchange rate with the U.S. dollar, and it would have been credible because it would have been backed 100% with U.S. dollar reserves. Suharto agreed to that, by the way, and the day he appointed me, actually the rupiah appreciated, David, 25% on the spot market as well as the 1 year forward market in Singapore. Just because I was appointed, because the markets knew very well what I was going to recommend, and that was a currency board. Suharto agreed to it, and then all hell broke loose because the U.S. wanted to topple Suharto, and they eventually did because they were against the currency board.
Just on the currency board, I thought, and this is just me jotting my memory from reading economic textbooks here, I thought one of the criticisms of, or one of the reasons for why this happened in the first place was that many Asian countries already had a fixed peg or partial peg to the dollar. As the dollar strengthened, exports became less competitive. Yeah, go ahead.
They had pegs. The baht had a peg, but the peg broke. The Indonesian rupiah had a peg and it broke.
That's right.
But those are pegs. Those aren't fixes. Currency boards. The only fixed exchange rate in Asia is Hong Kong. The Hong Kong dollar is a fixed exchange rate, 7.8 Hong Kong for one.
Sorry, can you just explain mechanically how is a peg different from a fix?
Well, just one. Don't jump ahead so fast. So
right.
there is one currency board in Asia. That's Hong Kong.
Yes.
And the Hong Kong dollar is just a clone of the U.S. dollar. It's exactly the same as the U.S. dollar because Hong Kong holds 100% reserves to back it up. So if you don't like your Hong Kong dollar, you take in 7.8 and exchange it for a U.S. dollar. And you know you're going to get U.S. dollars because the backing is 100%. So that's Hong Kong. Now, Hong Kong has no monetary policy with a currency board. They have an exchange rate policy, 7.8 to 1, fixed rate. That's it. They cannot engage in monetary policy. All these pegs can, and they engage in discretionary monetary policy. And the reason you know they do is that if you look at the balance sheets of those central banks, they have foreign exchange on the balance sheet. It moves up and down, up and down, up and down. And they also have domestic assets, and that's where the monetary policy comes in. And those move up and down, those domestic assets. That's not the case in Hong Kong. They don't have domestic assets on the balance sheet. They have foreign exchange. That's it.
Okay.
So that's the long and short lesson on that is pegged exchange rates look like they're fixed, but they aren't fixed. They're in fact what they call pegged but adjustable. They collapse from time to time.
Just on that, one more question on the financial crisis here in 1997, 98. The IMF package was widely criticized to have failed. Is that true?
Oh, it was a disaster. In Indonesia, it was a complete disaster. When the Thai baht blew out in July of 1997, shortly thereafter, the Indonesian rupee started getting wobbly, and the IMF recommended that they float the rupiah. Well, it didn't float on a sea of tranquility. It sunk like a stone, and that's when Suharto called me in. I was in Istanbul at the time, and this was in early February of 1998, I get a telephone call from Suharto's office in Jakarta, and he said, "Get out here immediately. I have to have a second opinion on this from the money doctor."
Mm-hmm.
So that was the sequence. The IMF was a complete disaster, and in the floating of the rupiah, because there were food riots starting. That's when they called me. The currency collapsed. The food prices went up. They started having food riots in Jakarta. They called me in, and that's how it started. And then once Suharto said I was his advisor, the rupiah rallied by 25% in one day, strengthened, and the U.S. panicked because they thought the financial crisis would take Suharto out, and they wanted him out. And then they got the IMF to come in, and the IMF going against the currency board idea. And then the Germans came in, and then they got all the G7 to come in. They all piled on Suharto and his chief economic advisor's idea of a currency board, because I had just stabilized in July of 1997 the Bulgarian lev. Bulgaria was hyperinflating. 442% per month was a hyperinflation peak. And we put in a currency board and crushed the hyperinflation in Bulgaria in July. And then later that year, I was the architect of the currency board in Bosnia-Herzegovina. So I'd just done two of these things. And they just stabilized tremendously unstable situations. And the U.S. and IMF did not want Indonesia to stabilize. And by the way, Japan was involved with that too. Japan was against Suharto. They didn't want the stability.
Right. So they didn't take your recommendation for political reasons, is what you're saying?
Yes. They were against it for political reasons. They were against it because they knew it would work. The Undersecretary of Treasury at the time was Summers, and Summers knew damn well it would work. And he told the President Clinton that it would work. And if it would work, Suharto was staying in the saddle. So they knew very well what I was recommending would work like a charm, just like it had worked in Bulgaria a few months prior, and just like it had worked in Bosnia, which by the way, the U.S. was behind both of those currency boards. And in fact, the one in Bosnia, it was contained as Article 6 in the Dayton Peace Agreement that settled the Balkan Wars in Bosnia-Herzegovina. The Article 6 said that Bosnia-Herzegovina must have a currency board for the first 6 years of its independent existence.
We're running out of time for today's session, so I'd like to move on to the U.S. bond market. But this is fascinating. I'd like to talk with you next time more about this piece of very important history, and ultimately what lessons we can learn and what lessons other countries have learned, and how it led to the vast accumulation of FX reserves held around the world. This experience and others like it.
That'd be great. Most of the discourse on the Asian financial crisis is pure propaganda. And
what's wrong? Give us one piece of propaganda that's wrong.
Oh, the propaganda that's wrong is one is that the currency board in Indonesia would not have worked. It's blatantly wrong. I just established two currency boards within a year of the point in time where Suharto agreed to this. And by the way, you know why Suharto in May of 1998 backed off and dropped the idea? It's because the U.S., in desperation, sent part of the Pacific Fleet down to do exercises off the coast of Indonesia, off the coast of Jakarta, and the military in Indonesia told Suharto to back off of the currency board idea. That's when he abandoned ship. So it was a full scale attack on Indonesia.
Okay, wait, just jot my memory, please. Why did the U.S. want Suharto out?
For a whole variety of reasons. And one is that Suharto happened to know that the Communist Party military in China had funneled about $1 million through a bank in Indonesia, in Jakarta, to Clinton's political campaign, his reelection campaign. And Clinton knew that Suharto knew.
Okay.
So he had to get him sidelined. Now that's one particular thing, and some of this is known because there have been legal cases and so forth involving this particular issue that I mentioned about the campaign financing. But there were other reasons too. There were other U.S. reasons, and one of those was at that time, Indonesia, the largest Muslim country in the world, did not have diplomatic relations with Israel. So there's a long laundry list of things.
Well, if that's true, then it's unfortunate that the entire country had to suffer economically because people at the top are playing chess, so to speak.
Yeah.
All right.
No, David, you said if it's true. No, it is true.
That's right. Okay. Well, I'm just giving the benefit of the doubt to the mainstream news here.
Well, David, let me remind you of Hanke's 95%.
There we go. Yeah.
95% of what you read in the press is either wrong or irrelevant.
Okay, let's move on. I do agree with that statement. Let's move on to close off on what you think is going to happen to the U.S. bond market, independent of what's been happening with the Japanese yen bailout. The U.S. long end of the curve was already moving up in the last 40-something days, by the way. And the 30-year had 27 straight sessions above 5% already. And Kevin Warsh last week at the FOMC made a remark about this. The reporter asked him, hey, why aren't you raising rates today? He said, well, if you look at rates in the bond market, not in the Fed funds rate, they've already been going up. And basically implying that the bond vigilantes have already been doing their job for them. Anyway, what is your assessment of the current situation, and where are we headed? Yes.
Yeah. The bond vigilantes are coming out of hibernation, and as we speak, the 30-year it is over 5%. It's 5.18 as right now this minute as we're speaking. It all comes down to the following things: the money supply is hot, and it's been accelerating. If we look at Divisia M4 measure, the money supply, and we go back to let's start in the second quarter of 2025, it was growing on an annualized rate of 4.6%. Then the third quarter of 25, the annualized rate jumps to 5.6%. Then in the fourth quarter of 25, it jumps to 7.5%. And in the first quarter, it jumps to 8.5.
Yeah.
So we have an acceleration in the growth rate in the money supply, okay, measured by Divisia M4, which is the broadest and most accurate measure of the money supply. If the money supply is growing and accelerating like that, we know that bond yields follow inflation. So bond yields go up. The inflation genie is out of the bottle because the money supply is growing at a rapid rate. That's one factor. The second factor is that we've got Trump's war on Iran, and that is spooking the bond market. Okay? And we have the increased deficit and the fiscal side in the United States. So the money supply is accelerating. The war in Iran is creating more risk and uncertainty, and the fiscal deficit remains out of control. If you add those three things together, it's a deadly cocktail, and it's a cocktail that the bond vigilantes had taken a sip of that cocktail,
Yeah.
That's the story. That's what's going up, and they'll keep going up. You don't want to be long bonds.
Do you think?
Those interest rates will go up, and that means what? If the interest rates go up, the price goes down.
Yes. Do you think that interest rates will continue to go up? I'm talking about the long end of the curve, even if the Fed raises the Fed funds rate, let's say in September?
Yes.
Okay.
Monetary policy is not about changes in interest rates. It's about changes in the money supply.
I see.
That part of the happy talk that Warsh was giving is not correct in my view. He never talked about the money supply. If he would have, he would have explained why the yields are going up, because the money supply is accelerating. It's not only high, it's those numbers I gave you, it's accelerating.
Professor, what happens then to consumer borrowing costs if the long end of the interest curve goes up?
They're going up because take mortgages. A 30-year fixed mortgage is the highest rate it's been since before the great financial crisis in 2008.
Okay.
And it'll work through but the reason, by the way, is the 10-year bond. The 10-year bond is the benchmark for everything. The credit card interest rates, mortgage interest rates, everything is keyed off of the 10-year.
Would you be long financial stocks right now? Don't banks lend money on the short end of the curve and borrow on the long end, meaning if the yield curve steepens, they make more money?
Well, if recent history is a guide, you want to stay long.
Yeah.
The banks, if you look at the profits have soared.
Right.
Now, this, by the way, this comes into the money supply thing that we're talking about, because if banks increase their profits, what happens? Their capital increases, and their capital asset ratios increase, and that gives them more capacity to make more loans, David. And if they make more loans, that's a contributor to the increased money supply growth. Mm-hmm. So all these things fit together, and it looks like the inflation genie is out of the bottle. They're going to have trouble getting it down to the target of 2%. In fact, I don't think they will get it down anytime soon, because all these current inflation numbers are baked in the cake a long time ago, depending on what was happening with changes in the money supply a year ago, or a year and a half ago, or 2 years ago.
Okay, bottom line, our cost of living is going to go up unless we pay back our debts. Is that correct?
Yeah, the affordability problem is Trump's Achilles heel and the Republicans' Achilles heel. They're the incumbents. They're the incumbents. Mm-hmm. Why do you think these so-called Democratic socialists? We just had a big win in the primary in Michigan last night, with a Democratic socialist winning. Why do you think these outliers, these kind of economic nutcases, are winning? Because of the affordability thing.
Yeah.
No matter what political stripe you are, if people earning below the median income level, and there are a lot of them, feel pinched.
Okay.
And they vote, and that's affordability. So they vote the rascals out. Whoever is the incumbent has a big problem right now, because you got a lot of people out there saying, boy, I'm strapped. Inflation keeps chugging along. If I want to get a 30-year mortgage, God, the thing is much, much higher than it was a year ago, or 2 years ago, 3 years ago, 4 years ago.
Final question, Professor, and then we'll close off today. If the long end of the interest rate curve continues to go up, the 10 and 30-year, we know that a lot of the money supply is in commercial paper at banks. Does that mean that the higher interest rates could potentially reduce the money supply, or at least slow the growth of the money supply? Is that how it works?
Well, no. It
Okay.
depends. It depends on the profitability of the banks and the bank's capital, and that the profitability is something in the market, but they also can change the bank regulations, which they're doing to ease up on the capital requirements. Now that's easier money. So even if the Fed funds rate goes up, if you're deregulating banks and allowing them to run with lower capital asset ratios, that's easy money policy. So looking at monetary policy, you've got to look at bank regulations are one of the most important things. And those bank regulations don't change very often, but they're changing now. And they're loosening them, giving the banks more capacity to make loans. When you ease up on bank regulations and reduce capital asset ratios, you give banks more firepower potentially.
Okay, got it. That was a great session. Thank you so much. We'll
Yeah,
leave it here.
Thank you, David. Great to be with you.
Great to have you on as always, and I appreciate you educating us on important topical issues. Where do we go to follow you?
You can follow me on X at Steve_Hanke, or your listeners sometimes send me an email, hanke@jhu.edu, and I put them on my weekly distribution list. So if you want daily real-time things, you go to X. If you want, for example, the weekly, what would be in the weekly? Well, this interview will be on my weekly distribution.
Yeah.
As well as articles I'm writing in Fortune, where I'm a senior contributing columnist in Fortune magazine. But those I send out on the weekly distribution.
Good. We'll put the links down below, so please do make sure to follow Professor Hanke on X, and do write to us. I'll put my email as well as Professor Hanke's emails. We've had a number of good guest submissions for emails for questions, and I encourage people to continue to do so. Thank you so much, Professor Hanke. I'll see you next time.
Okay. See you, David.
Thank you for watching. Please do like and subscribe.